Hi everyone. Okay, so let's do exercise 211. So in this exercise, it covers all the steps that we have discussed so far. Okay, it discussed having a look at the transaction, analyzing it, figuring out what's going on. We need to journalize it. Then we need to take from the journal entries and post it into the T accounts. Then we need to balance the T accounts or total them. Then we need to create the trial balance to make sure our debits and our credits balance. And then we need to create our three financial statements, our income statement, statement of owner's equity, and our balance sheet. Okay. So they have given us check figures. So once we have everything journalized, posted, and then totaled in our T accounts, we can create our trial balance and then start with our financial statements and then see from our income statement if our profit does match the 21,700 that they're telling us, then create our statement of owner's equity and then our balance sheet, and then they're giving us the check figure for our total assets. Okay. So they've given us our account names. So this is an existing company. They're not just starting this month. They've after its first month of operations. So 1 month has already happened. So now they're going into their second month. So their T accounts have balances. And when you're creating your T accounts so that you can add all of the other entries into it, just next to the balance that's there right now, just put the word balance, BAL. Okay. And then when you're have everything posted into your T accounts after, make sure you include that opening balance into your total, okay? Because it's always a running total. Think of the cash account. That's probably the best one for you to relate to. Your bank account or your cash account doesn't go to zero at the end of every month. If you had 15,000 at the end of last month, then you're going to have 15,000 at the beginning of this month. And then depending on what happens, you're going to include that 15,000. Okay, so that's where I'd start. And also you can add the account number next to it. Just again, get used to using proper account numbers. Okay, and then we have our transactions that happened for the month. So the first thing it wants us to do is record the entries for the month of February. So February 1st, performed work for a client and received cash of 8,500. So again, we have cash. Sorry, I was just adjusting my borders for my video. I noticed that the credits were being cut off. So we have consulting revenue, and as we know, our revenue, the normal balance for revenue is a credit. So we have a credit of 8,500, and we received cash. So we have cash of 8,500, and we have assigned the number of 101 for the cash account and 410 for the revenue account. Okay. Next entry. On February 5th, we've paid $5,000 regarding outstanding accounts payable. Okay, so we had accounts payable from last month outstanding of 8,000, so we're paying 5,000 towards it. So we're going to reduce that balance. So accounts payable is now being debited for 5,000 to reduce the outstanding balance, and we're giving them the asset called cash, and that's going to be reduced. So therefore, it's going to be credited for 5,000. And then the description is paid account. And you can see I've got February 5th next to the entry. On the 10th, we received cash of 3,600 for work to be done in March. And this is February. So this is unearned revenue. We have not done anything to earn that money yet. So we have to record that we received the money, right? So we have more cash now. So we have 3,600 in cash, but we haven't done the revenue yet. So it's unearned revenue of 3,600 as a credit and then received cash in advance. We called Fastco Rentals to book the use of some equipment next month. The $400 rental fee to be paid in full when the equipment is returned. Nothing has happened. Absolutely nothing has happened. So you'll see here, no entry. We've just asked if we can do the rental. Yep, you can rent it, pay for it after the fact. Yep, great. And nothing accounting wise has happened. February 17th, the owner withdrew 3,000 cash for personal use. So again, nothing personal can go through the books for the company. So the owner has to take a withdrawal. So we have Aaron Paquette withdraws 3,000, and then Aaron withdrew cash, so we're going to reduce cash and 3,000 credit for cash, and owner withdrew cash. The next entry and final entry, paid salaries of 10,000. So we can assume they paid cash. Salaries expense 10,000, and we're going to reduce our cash by 10,000. Okay, so that's the first part. So it has said record the journal entries, which we just did. Now they want us to post the journal entries to the general ledger or T accounts, including the date next to each posting. That's for keeping track. So we've got cash and consulting revenue. Sorry about that. Again, I had to adjust my columns. So we have the balance in there, as I mentioned. Set up all of your T accounts with the names and associated numbers, and you need to put your balances in there from the question. Okay, so once we've done that, now we have the cash of 8,500 from February 1st, and we had the consulting revenue. And of course, the revenue is a credit. So we've got 8,500 February 1st as our credit. Let's go up and find the next one. Accounts payable and cash for 5,000. Cash is being reduced by 5,000 February 5th, and accounts payable is being reduced, so it's being debited for February 5th for 5,000. The 10th, we have cash and the unearned revenue. So we have cash of 3,600 for February 10th, and our unearned revenue, which is a liability, for 3,600 on February 10th as our credit. No entry for the 12th. Aaron Paquette withdraws and cash. So cash again on the 17th is being reduced by 3,000, and we have withdraws of 3,000 being debited because it reduces the reduces the equity. And then finally, we have salaries expense 10,000 and cash 10,000. So we're reducing cash by 10,000, and we have salary expense for 10,000, and our expenses are always debits. So now we need to come up with the totals. And as you can see, I already have them here, but the way to do it is anything that has the normal balance of a debit, add up the debit side, subtract off the credit side, and you'll come up with your ending balance of 9,100 for cash. Accounts receivable hasn't been touched this month, so it has a balance of 3,800. Office equipment, accounts payable is our liability, so we start on the credit side. 8,000 minus 5,000 gives us a credit of 3,000. Unearned revenue, we have 6,200, the 3,600 from this month, 26 from last month. The 9,500 opening balance in capital. We have total withdrawals of 5,000, including the opening balance. Revenues, we had an opening balance of 41,700 plus 8,500 to give us 50,200. Salary expense is 20,000, rent expense is 7,500, and utility expense is 1,000. Okay, so now we've added those all up. So now it's saying prepare the trial balance based on the balance in your T accounts. So we've got all of the balances in our T accounts, and now we're going to put them in our trial balance. And what we need to do is put our account number, the name of the account, and whether its ending balance is a debit or credit. And you can see that right here in your T accounts. So here we have our trial balance. Pause the video if you need to check them closely. We have an ending total of 68,900 in both our debits and our credits. Okay. And then from there, it wants us to create our income statements. So we're going to start, as always, with our we need to create our financial statements. I gave away the punchline. So the first thing we're going to create is our income statement. And as you can see, by having the numbers in order like this, everything for your income statement is at the bottom, right? So you've got your revenue and your expenses. And then you've got your capital and your withdrawals, which is for your next statement. And then you have your assets and your liabilities for your balance sheet. And again, remember, each statement links together. So we're going to bring these down, and we have our revenue, list our operating expenses to give us our total operating expenses to give us our profit of 21,700, and that was our check figure. We're carrying that down to include with our profit. So we have our owner's investment of the 95, which was our opening balance. And then we have our profit. We're going to bring over our withdrawals to give us an ending capital amount of 26,200. Then we're going to create our balance sheet. We have our total assets once we list our cash, our accounts receivable, and our office equipment, 35,400, which was our check figure. Our liabilities, we have our accounts payable and our unearned revenue totaled together to give us 9,200. We have our equity. We know our ending balance in our capital account or our equity account is 26,200. That comes from our statement of changes. And then, as you know, we add total liabilities plus our equity to give us our total liabilities and equity balance of 35,400. Okay. Wonderful. Any questions on that? Oh, it did have an analysis question. I didn't copy that over though. Unearned revenue occurs when cash is received from a customer in advance of the work being done. The collection is not recorded as revenue, and we've talked about this before. It's a liability because the work either needs to be done or a refund needs to be given to the customer. Let me know if you have any questions. Thanks, everyone.